My name is Phyllis Kyle. I'm the Portfolio Operations Manager here at 1900 Wealth. I'm joined by Todd Brockwell, who is our President at 1900 Wealth, and Bobby Jones, the Senior Portfolio Manager. This morning, Todd's going to get us started off with a firm update, and then I'll cover a market recap, and Bobby is going to discuss the market volatility, and we'll close out with a question and answer. Todd, you want to get us going?
Sure, thank you. Good morning, everybody. Just a quick update on our personnel additions. We've continued to invest in our talent, and I'm excited to introduce three outstanding individuals, which we'll put forward, that have joined the firm recently. They bring deep experience and strengthen our capabilities across family office services, alternatives, and market leadership. First, Erica Krautheim has joined the San Antonio office, focusing on our family office offering and alternative strategies. Erica graduated from Georgetown University and began a career in New York with Goldman Sachs, working in structured credit products and operations. She later moved to Hong Kong, where she joined Goldman's management team before going to run the investment book for Pacific Century Group, which is one of Asia's largest family offices. After that, she founded her own consulting business working with family offices and later worked with Franklin Templeton to help launch their alternative platform. Erica recently returned to the United States after 14 years in Hong Kong and settled in San Antonio with her husband and two young children. So we're happy to have her aboard. Next, Ashton Moats has joined our Austin office as part of Melissa Anderson's team. She'll focus on family office services. Ashton is a UT graduate and a CPA. She comes to us from a Big Four accounting firm there in Austin, where she specialized in ultra-high net worth tax returns, trust, and gift taxation. Her technical expertise and experience working in complex family structures makes her a strong addition to our growing family office platform. And finally, Jay Celester has joined as the lead advisor for the Austin office. Jay brings 20 years of experience across capital markets, trading, and investor relations. Before joining us, he was a partner at Crowd-Out Capital, where he led aspects of investor relations and communications. He also held leadership roles at Pasadena Capital, Westlake Securities, and Tejas Securities. We're really happy to have him as our lead advisor there in Austin. We're really thrilled to have all three of these individuals on board. They each bring a level of experience and perspective that strengthens our abilities to serve our clients at the highest level. And I will point out, given as an Aggie, I get all the grief about hiring Aggies. We have two Longhorns that we added to the team. So hopefully our UT clients will be happy with these additions. So.
All right. Okay, I will get us started with a 2025 market recap. Let's begin with the global equity markets. As you can see by looking at the chart here, it was an outstanding year for the markets, even better than anyone anticipated, I believe, the beginning of last year. You can see the global markets up almost 23%, and the S&P 500 up almost 18%, with both mid and small cap doing well also. And the international markets had an outstanding year, unusually high returns. And as we look at what are the drivers or the pushers for this performance, despite the turmoil of the first half of the year, strong corporate earnings really prevailed. And that was probably the key driver, but there were several others. As we passed the stimulus bill, the big, beautiful bill, anticipation and expected stimulus that will happen this year, kind of gave a little more enthusiasm there too. There's also the easing of the regulatory environment by the new administration, also added some enthusiasm. Of course, later in the year, the Fed did lower interest rates, and we had a really strong third quarter GDP. It was up 4.4%. Now looking at the fixed income markets, also great performance. You can see by the chart on the top, the overall broad market index, which is the Bloomberg aggregate, was up 7.3%, but we had positive returns across all of the various sectors. When thinking about the key reason for that, I would say first, top of the list, would be the Fed funds being lowered 75 basis points 3 different times in the last quarter of the year. We also had a softening of the employment picture. And I mentioned before the strong corporate earnings. Those fundamentals also led to excellent performance within the corporate bond market, both investment grade and high yield. You'll notice the blue bar on the top, the high yield index was up 8.6% for the year. And municipal bonds did have some movement, but we still think there's plenty of opportunity on the long run maturities there. So we are seeking those opportunistically. So if you look on the bottom chart there, I broke down the total return of the Bloomberg aggregate into two portions. It's interest income, which is what we focus on when we buy bonds, but also the price movements that took place because of interest rate changes. Now, we never count on the price movements. When we buy bonds, we're focusing on the interest income, and that is generally the dominant factor in the return, and it was for last year and the previous year, but we happen to get some extra push from bond prices moving up as well. So that covers 2025. Let's look at what's been happening in the stock market in 2026. The first 2 months of the year, we saw a big rotation away from those mega tech companies and into the other sectors. I thought the best way to illustrate this was to show you on the left-hand side, this is the performance of various sectors in 2025. No surprise here, communication services and information technology led the pack, head and shoulders above the other sectors. But now take a look at the right-hand side of your screen, and you'll see there's been a bit of a change there. Both the consumer communication services and infotech are actually down for the year, where you have sectors like energy up 24.4% and materials up 17%. So there's been a really big shift the first part of this year, and we're only 2 months in. That is all I have for the recap. I'm going to turn it over to you, Bobby.
All right. Thank you, Phyllis. So one of the main reasons I wanted to talk with you this morning is just there's been a lot of news, in particular over the last week, but it really started, I get say, probably towards the end of the summer last year, around private credit. It's been in the headlines quite a bit, and it's an important part of what we do at 1900 Wealth for some clients, not all. And one of the main things that I really wanted to point out is trying to bifurcate what we see in the news versus what we're actually happening. So you can see it in the headlines, you can see it in the search trends, and you can see it in the amount of commentary coming off of the financial press. That kind of spotlight usually shows up when an asset class has delivered strong results. And private credit certainly has, with an average annual return to investors of 11% in the benchmark CDLI over the last 2 years. But success also tends to invite fear and speculation. This is a complex topic, and today I want to address it head on. This is a mixed audience, so I'm going to try to stay high level and focus on the big ideas rather than go into technical detail. But if I don't go deep enough, I'd encourage you to participate in the Q&A. A lot of media attention really started ramping last fall, as I mentioned, when we saw a few corporate frauds picked up again in the winter with a failed private to public BDC merger, and then more recently as accelerated as software stocks have sold off sharply. My goal today is to separate the signal from noise. Private credit is a big umbrella term. Much like the word alternatives, it can mean very different things depending on context. It includes multiple sub-strategies that vary by the type of borrower, the kind of loans being made, and the collateral supporting it. The main categories include direct lending, asset-backed finance, distressed, mezzanine lending, and venture lending. Each comes with its own risks and return profile. At 1900, we diversify our exposure across the whole private credit spectrum. However, when the media talks about private credit, they're usually exclusively talking about direct lending, which are loans made to middle market companies, often backed by private equity. The private credit market has grown rapidly over the past decade, and anytime something grows quickly, it draws attention. The biggest question people ask is, why is it growing? Well, the answer is pretty straightforward. These types of loans were historically made by banks. And over the last 25 years, the number of FDIC-insured banks in the U.S. has been cut roughly in half. And at the same time, regulations like Dodd-Frank and Basel III made these loans more expensive and significantly less attractive for banks to hold. Private credit stepped in to fill that gap. This wasn't accidental. Regulators wanted risk credit pushed outside of the banking system. This is a result of a shift that is structural and not cyclical. One of the main reasons private credit continues to grow is that it has delivered remarkably stable returns over long periods of time. Looking back more than 25 years, direct lending has produced consistent positive income, even through difficult market environments, with an average annualized rate of return of 9.5% since 2004. What stands out to me is that if you look at income minus realized losses, which is the economic earnings, and that's the chart on the lower half of the screen, annualized returns never fell below 2%, even during the depths of the financial crisis. That level of resilience is remarkable, and it underscores the attractiveness of the asset class. It's not surprising that adoption has grown steadily. This hasn't been driven by hype. It's largely been driven by investors sharing their positive experiences and outcomes over time. As the market has evolved, more structures have been created to allow individual investors to participate. There are several paths, each with different trade-offs. At 1900, we primarily use interval fund structures, which have lower leverage limits and are required to provide periodic liquidity. Most investors, however, are introduced to the space through non-traded BDCs, which often use higher leverage and have the ability to gate redemptions and, importantly, typically charge higher fees. These redemption mechanisms are not a weakness, though, I will point out. They're essential. Without them, private credit wouldn't be functionally investable for most investors. So what is private lending or direct lending? There's actually nothing novel or exotic about it. It's functionally very similar to the broadly syndicated loan market. It just serves smaller companies. The key difference is who originates the loan. In the syndicated market, Wall Street banks arrange the loans. In direct lending, the managers themselves source, structure, and hold the loans. A lot of attention gets paid to how fast private credit has grown, as if growth alone is a reason to worry. What gets talked about less is how closely this growth mirrors that of the broadly syndicated loan market from the early 2000s. That market eventually matured into a core part of the financial system, and I think direct lending is moving along a very similar path today. So much so, I actually stacked out the growth profiles. So the blue line here is broadly syndicated from the early 2000s, and the green line is the direct lending market since the mid 2015s. And you can see this remarkably similar growth trajectory. So what set off the alarm bells? Well, the first wave came from private credit from media coverage of large corporate frauds and bankruptcies. The media reported these were the result of private credit. Jamie Dimon in October famously issued a warning about private credit and said, when you see one cockroach, there probably are more. But what often gets overlooked is that most of these situations involved financing arranged by banks, not by private credit. If the concern is that direct lending lacks a regulated bank to ensure underwriting discipline, it's worth remembering that many of the largest bankruptcies in recent years were financed by banks whose underwriting discipline has shown cracks in stories like Tricolor, First Brands, and MFS. In fact, just yesterday in Miami, Jamie Dimon at a private lunch conceded these cockroaches he was referring to were loans made by his bank and sharply walked back his criticism of private credit. The actual direct lending defaults on this slide were largely company-specific, product liability issues, failed roll-ups, bad timing, or flawed assumptions coming out of COVID. These are not signs of systemic stress, they're just part of the lending business. If you zoom out, defaults today look normal. We don't see any acceleration in bankruptcy filings or trends highlighting any specific sectoral distress. I'll point out that default rates themselves can be more of a lagging indicator showing what has happened rather than a leading indicator predicting what might happen. One of the best leading indicators for credit quality is the health of the underlying borrowers. And on that front, the data is very consistent. Independent research from Standard & Poor's, Lincoln, and Cliffwater all tell the same story. Revenues are growing, EBITDA is growing, and interest coverage ratios are improving. In short, borrowers are in good shape and becoming in better shape. That aligns with commentary from managers like Blackstone and Ares. Fundamentally, company performance remains solid. So the next wave of media attention centered around Blue Owl. While Blue Owl has attracted a lot of attention, it's important to frame it correctly. This was a product design issue and not a credit issue. For those of you not familiar, Blue Owl is one of the 3 largest managers of direct lending. The firm raised approximately $2 billion in a private BDC called OBDC2, with a loose promise to investors that by the end of 2026, they would provide liquidity to them in the form of an IPO. Long story short, this failed spectacularly. Blue Owl responded by selling a third of the portfolio of loans at par about a few weeks ago and immediately returned it to investors while suspending redemptions and pursuing an orderly liquidation of the fund. This is not distress. This is a fund that is operating within its design constraints, and this was all widely reported. What was not widely reported, however, was that performance since inception has tracked the benchmark closely with a 9% annualized return over the last 9 years. This further underscores that this is not a performance issue or a credit issue. It is an idiosyncratic product issue. I personally believe that investors in private BDCs should not have been surprised about the Blue Owl process, as we saw a similar issue recently with a real estate-focused private BDCs. In late 2022, rising rates triggered a surge in redemption requests at the largest real estate BDC issued by Blackstone called BCRED. Blackstone enforced these limits as redemptions came in above their gates. They returned capital over time, they repositioned the portfolio, and all without collapsing the net asset value of the fund or sacrificing long-term returns. Looking back in time, with the benefit of hindsight, BREIT did what it was designed to do and has delivered respectable performance through an incredibly challenging investment environment. The key lesson is that semi-liquid funds can provide efficient access to private markets and demonstrate resilience during periods of stress. However, investors should understand that liquidity is subject to fund terms and market conditions, and it is not guaranteed. So the most recent wave of negative publicity for private credit has been fueled by the sudden and sharp sell-off of stocks and software companies this year. Advances in AI have spooked equity investors, leading to steep declines in software valuations. That volatility has spilled into loan prices in the broadly syndicated market, raising questions about what this means for private credit portfolios with software exposure. That fear reminds me a lot of retail investing in the high-yield space in 2017, when everyone thought Amazon would put every retailer out of business. What actually happened was more nuanced. Weak retailers disappeared. Strong ones, like Costco, thrived, and many retailers now partner with Amazon for logistics and cloud services. Talking heads today suggest that AI will rapidly commoditize software business models, that public software equity drawdowns imply a collapse in enterprise values, and that private credit portfolios are therefore overexposed to software risk. These narratives are not always reliable. Just last year, the prevailing view was that AI would significantly reduce the need for software engineers. Yet when you look at recent hiring data, including the chart in the top right, you see a clear divergence. Over the past 6 months, demand for software developers has accelerated sharply relative to the broader US labor market. Too often, the word software is treated as a monolith, ignoring meaningful differences across business models, particularly mission-critical vertical software embedded in customer workflows versus horizontal one-size-fits-all models. Our view at 1900 Wealth is different. There will be both winners and losers. Legacy one-size-fits-all software companies might have a challenging path ahead. Anthropic, OpenAI, and xAI, on the other hand, are both all software companies, and their future is looking pretty bright. The other thing that the financial media and even the equity community tends to get wrong is the structural seniority of debt versus equity. Senior lenders benefit from substantial equity cushions, and historically, software has exhibited lower default rates than most other sectors. Diversification matters, and our underwriting is extremely diversified and contemplates a broad dispersion of outcomes. Telecom didn't kill the high-yield bond market in the 2000s. Oil and gas pipelines didn't kill the leveraged loan market in 2015. And our view is that software will not kill the direct lending market in 2026. And if you're still skeptical about the resiliency of the software industry, remember, Salesforce has been calling for the death of software for some time now, and yet somehow the industry has continued to adapt and grow for the last 18 years. I want to close with this image because it has a much better backstory than what people realize. This poster was created by the British government in 1939 before World War II in preparation for what they believed would be immediate, devastating chaos. Millions were printed, but almost none were ever used. Why? Because the worst case scenario didn't arrive the way people feared it would. Ironically, the poster survived not because of collapse, but because it was never needed. That's a useful lesson for the markets today. The presence of guardrails, liquidity tools, and contingency planning in private credit is being mistaken for evidence of distress. In reality, it's a sign of preparation, not failure. History reminds us, preparing for stress doesn't mean the system is broken. Often, it's what holds it together.
Thank you, Bobby. Okay, so let's see. Let's stop sharing, and then we'll see if we got some questions. Hit the stop share, and then
Our camera's not on.
yeah, our camera is not working.
I think it is. Okay.
Okay, all right. Here, let's see.
All right,
We have
let's see
a
what we
specific
got.
question, and I have one from someone yesterday. All right. For Bobby, this is a bit of a technical question, but I've seen paid in kind or payment in kind loans coming up in the private credit space. Would you please explain what these are and what they mean for the credit market?
Sure, and thank you for asking the question because it's very important. This is another topical piece that the news likes to report about. As you can imagine, there are a lot of areas to research and explore about private credit. I would make this a 3-hour meeting if Todd would let me. But so what is paid in kind? Paid in kind is a mechanism whereby borrowers can elect to defer an interest payment effectively. And what they don't pay today gets added to their loan balance. So going back to the subordination of equity versus debt, if a borrower elects to do that, they just have more that they have to pay back in the future. And so there's really two forms of paid in kind, or it's referred to as PIK. There's good PIK and there's bad PIK. So if you kind of refer back to that first page that had the different forms of private credit, within venture lending, PIK is probably okay because they probably meant to have that feature out the gates. So I'll pick SpaceX as an example. If you wanted to go lend money to SpaceX, there's a pretty good chance that they're growing, they're investing in rocket ships and launch facilities. They may not have the capital today to pay for it, yet we see almost $1 trillion of equity value. We could lend some reasonable amount of money against that and accept payment in kind, understanding they'll grow an IPO in the future to be able to pay us back. That's probably a judicious use of PIK. Some vaccine administering clinics, levering them at the top of 2021. They go cash pay for a few years, but then as the pandemic slows and vaccine administration comes down, if they elect to use PIK, that means their business is in distress, and that's probably not a good thing. What I would say is that across the board, and going back to my comments on dispersion, I fully believe that there's going to be some folks that get stung by this. For us and in our portfolios, I'm very pleased to say that we are very, very diversified. And so if across the industry, PIK is about 8%, then some lenders have, teens level PIK percentage in their portfolio, which means if you're expecting a 10% coupon, maybe only 8.5 of that comes in cash, then the manager actually has to figure out how to pay you back more that they don't have from current income streams. Our portfolios that we invest in direct lending only have about 4% PIK. And so I think that's evidence of one, positive selection from our underwriting partners, and two, just a reflection of the mass diversification. And the other point that I would that I would make is where you have seen issues with some private credit folks, concentration is usually the issue, whether it's concentration of security, so a lot of people going into junior capital versus first lien loans, or a portfolio of, call it 100 loans. If you have 10 or 20 of those go bad, that's going to be pretty painful for the shareholders. For us, we are well diversified over more than 4,000 different positions. So what I would say in a nutshell is pick is nothing new. It's been around for decades. There's good, there's bad. You can't just paint it with one big brush. So we've got another question in here. It looks like, okay. Surprised by the market response on Monday coming out of this weekend's events. Oil higher, where are we going from here? Yeah, that's a great question. So, what we typically have seen, and I'd say that the response in the market this year to geopolitical events is right in line. I think that so much research has been done around how markets behave around events like this that most investors have gotten pretty attuned to the fact that it's a sell the news type event, but then it doesn't last for long and buy the dip. And that's exactly what we saw. So,
yeah, it was just delayed by a day.
Yeah.
I expected to walk in Monday morning and see what happened Tuesday morning.
Yeah, I would say, look, the blockade in the Strait of Hormuz is very critical to the prices of oil. The longer this goes on, the more inflation possibly creeps up, the more some of the economic growth that we're predicting this year may come down. But I was pretty pleased to see a promise to backstop security guarantees yesterday to try to get that oil flowing again. And more critically, for investors on the call who've participated in some of the direct series offerings that invest directly into minerals. Looked like we saw some news out of the Wall Street Journal this morning that that manager was pretty active, hedging their book for the rest of this year at pretty attractive prices. So, there's gives and takes, but on balance, I would say that most of what we saw this past weekend really reinforces the long-term stability of the world. And for the shorter term narrative around economic growth for America, that's all kind of intact. I mean, I think that the AI infrastructure spend, CapEx cycle is continuing, and the productivity we're going to start seeing coming off of these large cap companies pretty quickly, which should power earnings growth this year.
So I have the one I had was
Oh, good.
Iran, so I think we covered that one.
Why don't you just talk? We've got a couple minutes left. Talk about the Fed rate and talk about where you think interest rates may go for the rest of this year.
Yeah,
with your crystal ball.
Exactly. Yeah, that'd be great to know exactly where it's going to go. I think it's anybody's guess. So clearly, President Trump wants interest rates lower, and if I've learned anything studying him, it's you kind of have to take him at his word and at face value. Now, the only tools that really exist to adjust interest rates are on the front end of the rate curve. And so, in mid-May, Fed Chair Powell is going to be stepping down. President Trump's nominated Kevin Warsh to step in. And honestly, he was probably the least likely candidate as it relates to pulling somebody in to bring interest rates down pretty quickly as he may want. Having said that, I think the market thinks that we're not going to see any cuts until September or October of this year. And I think a lot of that has to do with the fact that, we saw producer inflation last week in the threes, which is a little bit higher than where they want it to be on a short-term basis. We had gotten gas at the pump down pretty good, but what's happening in the Middle East right now is going to put some pressure the other direction on that. So, net, what I would say is that the economy feels good. The biggest issue that we have really is around housing price affordability. And quite frankly, the Fed doesn't have many tools in their toolkit other than quantitative easing, which would take some pretty difficult economic times to really justify deploying in order to bring down mortgage rates much further than, call it 6% where they had landed last week. But realistically, I think a long-term mortgage rate in the mid-5s to 6 is about appropriate for where we are in this economic cycle. So, I think the market's looking for a few cuts this year. That's about it in the cutting cycle. And then after that, we should be done. But, look, that's a guess as good as the next 24 hours, and everything may change from here on out. And so the other thing I'll put out there is I went through a lot of detail in my presentation. And so if you would like the slides, reach out. Happy to send you a copy of the deck. I will kind of plug for just a second. A lot of the research that I've done in here is, pretty bespoke. And a lot of these charts I really haven't seen elsewhere. So some interesting things in it.
So reach out to your advisor if you'd like to get a copy of that or want to discuss further. There's good information that y'all put together.
Yeah. Thank you guys for joining us. We appreciate you taking time out of your day to join us here. Everyone, thank you so much and have a great day.
Thank you.